Bring on board Pirojsha Godrej, the executive chairman at Godrej Properties, joining in on the show right now to talk about their numbers. Pirojsha, great set of numbers coming in this time, both on a quarterly as well as full year basis. Best ever quarterly and annual sales, net profit, collections, all of that. Can we expect this momentum to continue and sustain going forward as well, is the question.
The team has done a fantastic job ending the financial year 24 on an extremely strong note across all operating parameters, as you mentioned. We do expect the financial year ahead to be another very good one. We had done a lot of work to build our portfolio through very active business development over the last few years when we'd felt that land prices were suppressed, and we did expect to see an upturn in the cycle, which is now fully here, being seen very strongly across markets. So the portfolio for new launches that Godrej Properties has is actually quite a bit stronger in FY25 than it was in FY24. So we certainly hope to be able to build on the strong operating momentum we saw last year.
Some very solid guidance for FY25 in terms of your booking value in pre-sales. You've guided for 27,000 crore. Can you just throw more light on that? Because what we want to understand is that what is driving this confidence? Because 27,000 crore is almost like what, $2.5 billion, $3 billion actually.
I think a few things are helping drive the confidence. One is, of course, in FY24 itself, we did about 22,500 odd crore of sales. So this is about 20% growth on that, which is our long-term aspirational growth rate that we'd like to maintain. So I think we've demonstrated success at a very rapid scale up in sales over this past year. If you look at our numbers last year, actually a lot of the growth came out of the NCR market, where we grew by 180% to cross 10,000 crore in sales last year, and the Mumbai market, where we grew again well above 100% to achieve about 6,500 crore of sales. And we had more moderate growth in some of our other major markets like Bangalore and Pune. This year, we feel, as we look at our project pipeline, that all four of these major markets should be firing on full cylinders, and therefore not just two big contributors to growth, but all four markets we expect will do well. Additionally, in the fourth quarter, we added two new projects in the Hyderabad market, which is another very large residential real estate market in the country. And we're looking forward to marking our first launch in Hyderabad later this financial year. So those additional geographic levers, we think, again, give us a lot of confidence that we can see this kind of growth. And lastly, I think the market conditions that we're seeing remain very strong, and we're quite optimistic that we're kind of mid-cycle now, so that we will have another good year of real estate demand ahead.
You also take us through what the outlook is when it comes to your commercial portfolio. By when do you see 100% leasing for all your commercial projects?
Well, typically the way leasing for commercial office works is that most of it happens in the year or two after the project is delivered. You do typically have a little bit of pre-leasing and then a lot of leasing activity once the project is ready and tenants can come straight into the development. What's exciting for us this year from a commercial point of view is that most of our commercial buildings last 3 or 4 years and are now reaching completion. So we have two projects completing this year in Bangalore, a project completing in Pune, a project completing in Golf Course Road in Gurgaon. So all of those will add very substantially to the stock of ready inventory we have on the commercial side. And I expect it to be a very strong year from a leasing perspective. FY22 and 23 had seen a big dip in leasing activity as I think the effects of the pandemic, work from home, concern about how ready people would be to come back to offices was still playing out. I think we've already seen a sharp improvement in financial year 24, where leasing activity has been quite strong. And we've seen, for example, in our building here in Vikhroli, Godrej 2, getting very close to 100% leasing this year.
Right. Let's also talk about the debt that you have on your books after 11 straight quarters of rising debt. It's finally come down. Are you more comfortable with the current debt levels, and would they go down further from here?
We had guided publicly, on a long-term basis that we'd like to operate the business with a gearing anywhere between 0.5:1 to 1:1. Anything under 0.5:1, frankly, we think would not be adequately taking advantage of the kind of growth opportunities present in the Indian real estate sector today. And, if we were getting over 1:1, that might be a sign that we're perhaps putting a little bit too much risk onto the balance sheet. So we think anywhere in that range is where we are comfortable operating. As you would recognize, 0.62 is towards the lower end of that range. So we do think we have significant headroom for investment this year. And I also think we expect a very strong growth in cash collections from customers and operating cash flow. We've always tried to explain to the market that our view is that in this business, the first thing that has to come is the capital, which we raised 4 or 5 years ago, just before and during the pandemic. The next thing that has to come is the business development. And we've been very successful, we think, in adding a strong set of new projects to our portfolio over the last 3 or 4 years. Once you have those projects, you, of course, bring them to market through launches, and you see booking value growth, which, again, as I mentioned, has been 55% and 84% for the last 2 years. And then after that kind of booking value growth, the next thing is the customer cash collections, because you will start constructing these projects, at various construction milestones. The cash that customers who have booked, the cash that they owe you will start coming in. So we expect to see very sharp growth in cash collections and therefore operating cash flow over these next couple of years. And that will help us, continue to grow rapidly while maintaining our gearing level in this band. But we have no aspirations, I should clarify, of, reducing debt beyond this 0.5 to 1 band, because again, we think that is not fully capturing then the opportunities that the sector is providing us today.
If you like this video, then like, share and subscribe to ET Now.